Hello and welcome to the latest Insider interview. Our guest today is Mohneet Dhir, who is the product manager of Vanguard's LifeStrategy range. Mohneet, thanks very much for coming into the studio.
Happy to be here, Sam.
It's been 2 years since we had you in the studio. So how has the LifeStrategy range performed since then?
Look, the last 2 years have obviously been extremely volatile, and it's been a bit of a roller coaster ride for clients. There's been a lot going on. There's been geopolitical crisis, the world recovering from COVID, political movements across the world and developed economies. So essentially, in a nutshell, a lot going on. And markets have been extremely volatile responding to that. Now, when we look at the LifeStrategy funds in that environment, they've actually done really well for investors who've had the discipline to remain invested in the LifeStrategy funds that they have exposure to. So LifeStrategy 20, for example, in the last 2 years has returned just over 10%. And then when we go up the equity spectrum, that number goes up, and going up all the way to LifeStrategy 100, the return has been just above 34%, so quite a strong return.
You have this range of funds ranging from 20% in equity and 8% in bonds up to everything invested in equity. So how are they managed, and has there been any changes in how they're managed over the past couple of years?
LifeStrategy funds are essentially designed based on our 4 key investment principles. So the first one is cost, trying to keep the cost low. As many of our investors will know, we always try and find small cost efficiencies so we can pass more return back to investors. The second one is discipline. So the strategic asset allocation that the funds apply essentially means that it forces people into having the discipline to maintain their asset allocation. What that really means is that we don't move the goalposts when markets get volatile, because market timing in the short term can be a very dangerous thing for investors. Now, the third one is goals. So essentially giving people the options to be able to find the right LifeStrategy fund for them according to their own goals. And lastly, it's balance. So finding that balance in a multi-asset portfolio through equities and bonds and having that right split, as well as having the global diversification that you get through that split. So for LifeStrategy funds, we essentially have 5 different products, starting from LifeStrategy 20, which is 20% equity, 80% bond, and then it goes up in 20% increments of LifeStrategy 20, 40, 60, 80, and 100.
2022 was a difficult period for many investors. We saw interest rates rise, and this actually had a very negative effect on bonds. So we had an unusual environment where actually funds with more bonds performed worse than those with more equities, which is not what you'd actually hope if you were trying to be a defensive investor and allocate more to fixed income. So why did this happen, and could it happen again?
I think it's important for investors to remember that 2022 was not just driven by one event. It was a very toxic environment of multiple different things going on. You had a geopolitical crisis, the world was still recovering from COVID. You had years and years, decades of extremely low policy rates, the effect of which was building up over all of these years. And then on top of that, obviously in the UK in particular, you had the Liz Truss debacle, which obviously sent bonds in a downward spiral. But you could see how nervous the market was. And again, it wasn't just one factor that led to that, it was many different factors. The good thing, however, is that it was short-lived. In the broader sense of, if we zoom out a little bit, over the history of markets or over the last 5, 10, 20 years, during that period, that negative performance period of bonds that we had, was still short when you look at it, zoom out and look at the big picture. And now this year, obviously, and last year as well, we've already started to see bonds recover as central banks move into a more lower rate environment compared to where we were in 2022.
And are we therefore in a more normal economic environment at the moment compared to the past few years? Inflation is lower, interest rates have probably peaked and are now coming down.
In some sense, yes. So with policy rates in particular, we are starting to see policy rates coming down now, but we don't think we're in a normal economic environment. And we've been telling investors this for the last few years. For a good probably around COVID time, we started talking a little bit more about this, because even when you think about COVID, there are after effects. If you think about how much governments borrowed, what does that do to the underlying market? What does that do to economics? of different countries. The reality is that we're not in a normal economic cycle, which means that there's more uncertainty, also means that there's potentially more volatility, which is why having a fund like LifeStrategy, which forces that discipline in a way through strategic asset allocation, along with having that balance and diversification of being invested globally, will help investors ride through this sort of volatile, uncertain period.
So looking ahead to next year then to 2025, what should investors be worried about? What is abnormal about this environment, and how should that impact their investment journey?
Unfortunately, there's not one factor similar to how we saw in the last few years. We do think, obviously, some of the factors in the last few years have sort of, gone away, especially in terms of extremely high monetary policy rates. Now we're starting to see central banks cutting rates well within this into that cycle. However, when we look on the geopolitical side, for example, there is obviously increased risk again, whether it's within the Middle East or the sort of effect of Trump's tariffs next year, and what impact does that then have on inflation and growth. And all of this really does introduce uncertainty into the market next year, potentially. Unfortunately, with these things, especially with fiscal policy measures that we see out of the US, the impact of that is never quite sort of easy to see straight away. It takes time, because fiscal policies realistically take time to get implemented, and the effect of that to then show through in economic data takes time as well.
We've seen a big rise in the popularity of bonds on our platform, and actually the LifeStrategy range is a very common way for people to actually get exposure to those bonds. Bonds had a bad run in 2022. They're now starting to perform better and offer better yields. So why is fixed income important for a balanced portfolio?
I think 2022 in a way was obviously very painful for some of the sort of bond investors, bond heavy investors. However, those who did stick to having the discipline to remain in their investment did benefit over the last few years, because as we've seen, bonds have had this strong period of performance this year and last year as well. So we do think bonds are back, especially when you're looking at a policy rate environment where policy rates are coming down. Bonds obviously do benefit from that, with bond prices going up. What's interesting this time around is that even though we're expecting policy rates to come down, we think the average level of policy rates going forward is going to be higher than what we've been used to. So since the financial crisis, rates have been close to sort of almost zero and negative in some cases. Going forward, we think that's going to be more around 3.5%. Now, from a yield perspective, that's very attractive. So fixed income has become an even stronger ballast in a multi-asset portfolio now, and potentially going forward with that sort of additional yield component built in, which you didn't really have post the financial crisis. So it's still doing its job, but it can do its job even better as a defensive element in a portfolio. You've got potentially more income through higher coupons on bonds because of the higher yield. You've also obviously got that potential sort of overall yield of your fixed income portion going up. So the potential income you can earn on your bonds per unit of risk that you take has gone up, which is actually very attractive for a fixed income investor and for a multi-asset investor with fixed income in their portfolio.
Looking ahead across the LifeStrategy range, are there any forecast returns that we could give to customers? What is the range of returns you could get from the different types of strategies that you offer?
As of sort of last few months, so the last forecast that we have is as of June 2024, and then looking forward to the next 10 years from that point onwards, our models are forecasting that a LifeStrategy investor could get returns of anywhere between 5.3% going up all the way to potentially 5.7, 5.8%, which again just shows you that that's quite a strong return. Without having to tinker your portfolio or try to make asset allocation changes and try to time markets. And that's based on strategic asset allocation and having the discipline to hold to your LifeStrategy exposure that you have, depending on obviously which fund you're in. So 5.3 is for LifeStrategy 20, and then going up all the way to LifeStrategy 100 to about 5.7, 5.8.
Mohneet, thanks very much for coming into the studio.
Thank you so much.
And that's all we've got time for today. You can check out more insider interviews on our YouTube channel, where you can like, comment, and subscribe. See you next time.